So it was a week during which the rand continued with its volatile ways. The interest rate was kept on hold, and the market geared up for the ratings announcement by S&P Global. Well, Economist Mandla Maleka joins us now just for a wrap of the top economic stories of the week. Mandla, good evening. Thanks for coming in.
Good evening.
I suppose let's start with this interest rate announcement. Largely expected, rates have been kept on hold. But I suppose we've got to get used to the fact that perhaps the interest rate cut we saw in March was the last one for the year, and we should prepare ourselves for a hike soon.
Yes, maybe perhaps not for a hike soon, but the next move could be higher compared to what we expected beginning of the year. There's been some few changes, in particular on the inflation front. Initially, all of us were expecting the inflation to continue to surprise on the downside. But I think from now, the March numbers, 3.7% year on year, was our last one. The last print for April, rather, was about 4.5%. From here onwards, we're going to see the build up from VAT, the petrol prices, and that could, in a way, jack up the inflation basket on the upside. And tied with that is going to be the weakness of the rand as well, or rather the volatility of the rand that could add some pressure on our inflationary front.
And I want to keep you on that point, because inflation is seen to be, at least from the Reserve Bank's perspective, driven in the next few months by the oil price and this volatile currency, which in turn is pretty much driven by what's happening with the dollar at the moment. It's roaring. Do you think this US currency still has more steam in it to go even higher?
I think so. I think the market in general expect the US to tighten their rate further. Yep. There is a debate there by how much, but one thing for sure, we all agree they're going to hike them further. But more than that, what we see on the long-term rates in the US, the benchmark 10-year rate, has topped about 3% for the first time in 7 years. And if that indicates that economy is on the growth speed, and if it continues, it may possibly then attract global savings back into the US. So the dollar has got, again, an appreciation bias going forward. It may probably end the year at 1.10 against the euro. And that's quite a huge upside, in which case then it means the rand could be under pressure.
Right, one of the other talking points of the week was, of course, the lead-up to what will happen later this evening. Ratings agency S&P Global giving us the announcement of their rating. How much of a factor do you think Ramaphosa would be when they consider what their decision would be? I mean, largely we expect it to remain on that stable outlook. But of course, so much has changed since their last statement, hasn't it? We had this confidence coming with the election of President Cyril Ramaphosa. How much of that would be a consideration for them?
I think very much part of it will be considered. Although, as you say, it won't change the decision really. Perhaps we may be deemed to be very stable, but that's going to work to our positive stead as a country. Mind you, the fiscal position or all your other financial metrics haven't changed, and they won't change by much in the next 6 to 12 months. However, your political front has drastically changed, and that's going to put us in good state. But more than that, the Ramaphosa event tied up with the improved investor sentiments. They have already jacked up growth expectation for this year at about 2%. Next year, perhaps sub 2.5%, but still on a positive trend. So it's going to add, and maybe perhaps we may even get the write-up from Standard & Poor appreciating that move on our political front, that it has changed, and therefore even the attention given to the governance issues impacting on the country and the government itself, those ones are going to stand us in good stead, and we may even get a plus from S&P.
Having said that, so we have the ratings table looking as follows. Moody's, which has always been the most, let's say, generous of the three major rating agencies, have capped us on this investment grade. Fitch and S&P Global, we definitely well into sub-investment grade. What will it take, though, before we start seeing a move, a genuine physical move in the direction upwards, and perhaps to a point where we see both these rating agencies putting us back into investment grade? Are we far off from that?
In a way, it's going to be a challenge, but we're in the right path. If we were to go with the print that S&P issued in November last year, there were some highlights that what will drive this economy back, or rather potentially back to re-rating out of the sub-investment grade, amongst others, will be a drastic and convincing and persuasive growth in our per capita income. Now, we know that has been a very big challenge. Where we, as we speak currently, I think as a country, we're talking about $6,000 per person. Now, if you can see that figure probably improving to near $8,000 per person, that could stand that again in good stead, and it may perhaps in a way force then the S&P to re-rate the country on the upside. But more than that, it is going to be the fiscal matrices also that have to come to the party. Here we're talking about debt to GDP. If maybe perhaps it is sustained at a level of about 50% of GDP, more or less, or more, with the downside bias, we may probably find ourselves again having to bail ourselves out of the sub-investment grade. But more than that, of course, going to have to be growth. Our growth numbers going to have to be surprising on the upside, or continuously so, never go down below 1%. We know this country grows better at 3%, but that's going to be a tall order in the short term.
No, indeed, the economic fundamentals are crucial. Well, we'll leave it there, Mandla. Thanks indeed for talking to us. That was Economist Mandla Maleka.